So hello everyone, our main focus today is to present and evaluate 7 companies through their common sense and also ratio analysis. So we will go through one by one to see their financial performance and also choose the best company for our potential investor. For the first company, Krayon Industri Berhad, we will start with the balance sheet. Cash and bank balance decreased in 2024, showing that the company may have used more cash for investment or daily operations. Inventory also decreased, which suggests better inventory management and less exit stock. Meanwhile, for trade and other payable remain quite stable, meaning the company managed its short-term obligation consistently. Retained earnings show a slight increase, indicating the company was able to keep more earnings within the business and strengthen its financial position. Next, for the income statement, cost of sales decreased slightly about 0.8, showing improved cost efficiency in operations. As a result, profit for the financial year increased by around 0.6%, which reflects better profitability and stronger performance in 2024. However, administrative expenses increased by about 0.8%, which may be caused by higher operational and management costs. The company should monitor this expense carefully to maintain profitability growth.
We move to common size analysis for Krayon Berhad. For cash, it decreased by 7.01%, showing that the company used more cash during the year for its business operations and activities. Second, inventories increased slightly by 0.26%, indicating a stable inventory management and consistent production level. Lastly, trade and other payables decreased by 0.31%, indicates a better control of short-term liabilities and improved debt management by the company. Overall, the company maintained stable financial management with controllability and efficient inventory handling. We move to income statements. First, other income decreased slightly by 0.80%, indicating that the company relied more on its core business operations rather than non-operating income. Second, administrative expense decreased by 0.30%, showing better controls over operations and administrative costs. Lastly, taxations increased by 1.75%, which may be due to higher taxable income earned during the year. Overall, despite some changes in expense and taxations, the company continued to show stable operation performance in 2024.
Good day everyone, so today I will present the common size analysis of IOI Properties Group Berhad for 2023 and 2024. So from the balance sheet, cash increased slightly from 4.12% to 4.45%, showing better liquidity, and inventories decreased from 5.66% to 4.17%, which may indicate better inventory management. Trade and other payables increased slightly, showing stable supply payments, and retained earnings also increased, reflecting stronger accumulated profit. Next, from the income statement, cost of sale increased from 57.75% to 65.39%, which caused gross profit to decrease from 42.24% to 34.61%. And this shows that operating costs became higher in 2024. Administrative expenses also increased slightly but remain controlled. In conclusion, the company shows stable financial statement with better cash management and stronger retained earnings, despite higher operating costs. So, thank you.
And next, let's move on to Padini Holdings Berhad. As we can see here, cash and bank balances increased by 4.51%, showing that the higher liquidity due to the strong sale performance. And also for the inventory, it is decreased by 10.24%, showing that the company are able to sell their product faster. Also, for trade and other receivable, we can see it is decreased by 0.11%, indicating that the company have better collection of payment from their customer. For the liabilities component, trade and other payables decreased by 2.25%, showing that the company have settled their payment to the supplier efficiently. Moving on into income statement component, as we can see here, cost of sales increased by 3.16%, which means the company are spending more to produce and sell their product. Due to this, gross profit decreased by 3.16%, showing that the company are earning less from their sales compared to the last year. Also, for the administrative expense, it is increased slightly by 0.26%, which means the company are spending higher on the management of the company.
Next, I will explain the balance sheet and income statement for Sangari Property Berhad. Starting with the balance sheet, cash and cash equivalents increased slightly from 3.78% in 2023 to 3.88% in 2024. This shows slightly stronger cash position for the company. Inventories decreased slightly by 0.29%, which may indicate better inventory management and reduced excess stocks. payable also decreased slightly by 0.04%, suggesting improved management of short-term obligations. Meanwhile, retained earnings increased slightly from 18.98% to 21.10%, showing that the company retained more profits within the business and strengthened its financial positions. For the income statement, cost of sales decreased slightly by about 2.55%, indicating a better cost control and operational efficiency. As a result, profit for the year increased slightly from 12.15% to 12.18%, reflecting a stable profitability in 2024. However, administrative expense increased by around 0.7%, possibly due to higher operating and management costs. The company should monitor these expenses carefully to maintain the profitability growth. Overall, Sandari Property Berhad showed a stable financial performance and improved financial management in 2024.
Based on the common size balance sheet analysis for Amway Malaysia Holdings Berhad, cash and cash equivalents decreased from 55.36 in 2023 to 42.03 in 2024, indicating that more cash was utilized for business operation and investment. In contrast, inventories increased from 19.83 to 30.21, showing higher inventory holdings to support business demand and sales activity. Meanwhile, trade and other payables decreased from 42.07 to 33.82, reflecting better management of short-term liabilities. Lastly, retained earnings increased from 22.83 to 26.65, indicating stronger profit retention and improved financial performance. Based on the common size income statement analysis for Amway Malaysia Holdings Berhad, cost of sales decreased slightly from 75.24 in 2023 to 74.81 in 2024, indicating better cost control in the company's operation. As a result, gross profit increased from 24.76 to 25.19, showing improved profitability and stronger operational performance. Meanwhile, selling and administrative expense decreased slightly from 9.63 to 9.85, reflecting more efficient expense management by the company.
Now I will present the common size analysis of Petronas Gas Berhad's balance sheets. Firstly, cash and banks balance decreased from the year 2023 to 2024. This drop may indicate that the company used a lot of cash for its investment activities and also operating expenses. Secondly, borrowings shows a very significant decrease from 6.69% to 0.72%, which means that the company has greatly decreased its debt. This reflects a stronger financial position with lower financial risk. On the other hand, inventory increased slightly from 4.80 to 5.13%. It shows a small build-up of stock. And overall, the balance sheet shows that the company is reducing debt and strengthening its long-term asset base. Moving on to the income statement of Petronas Gas Berhad, the revenue remains constant for 100% for both years, which is our base for the comparison. Cost of sales increased slightly from 64.52% to 65.17%, which caused that the gross profit decreased slightly. It indicates a small reduction of profitability efficiency. Finance costs increased, and it likely due to the higher interest or financing obligation. Income tax expense decreased slightly, which helped to support the company's final profits. Finally, profit for the financial year remained stable around 29% for both years, and it shows that despite higher costs, the company maintained consistent profitability.
Next, I will present the liquidity and solvency analysis among the selected companies. These ratios are important because they help investors evaluate the company's financial stability, liquidity position, and level of financial risk. Firstly, IOI Properties Group Berhad recorded the highest current ratio at 4.945, indicating that the company has a strong ability to meet its short-term obligation using current assets. Next, Padini Holdings Berhad achieved the highest cash ratio at 2.932. This shows that the company maintains stronger cash reserve and has better financial flexibility for immediate commitments. In terms of financial risk, Kawan Food Berhad recorded the lowest debt equity ratio at 0.1741, indicating lower dependence on debt financing and a healthier capital structure compared to the other companies. Therefore, based on the liquidity and solvency analysis, Kawan Food Berhad, Padini Holding Berhad, and Petronas Gas Berhad demonstrate stronger financial stability and may be more attractive from an investor perspective.
Based on the profitability analysis, I will recommend Amway Malaysia Holdings Berhad as the best company for investor. Why? Because although IOI Property Berhad record the highest profit margin, but profitability should not be evaluated from one ratio only. It will still also need to consider how efficiently the company generates returns and use in asset. Amway recorded the highest return of equity (ROE) at 0.326, show that the company generates strong return for shareholders. Besides that, Amway also achieved the highest total asset turnover ratio at 2.295, which means the company used the assets very efficiently to generate sales. Therefore, based the profitability performance overall, Amway Malaysia Holdings Berhad is the most attractive company for investment.
As we can see from the ratio analysis, we can conclude that Amway Malaysia Holdings Berhad is the best investment choice among the 7 companies. The company shows a strong profitability, efficiency, and liquidity. This can be proved by Amway had the highest return on equity of 32.6%, showing effective return to the shareholders. Also, this company had the best receivable and total asset turnover ratio, showing efficient asset management. Amway has a sound financial structure with a current ratio of 2.033 and cash ratio of 1.105. In addition, the company maintains stable profitability despite lower consumer spending and increasing competition. Amway has performed well across profitability, efficiency, and liquidity compared to the others company. Thus, Amway Malaysia Holdings Berhad is the most attractive investment option with a strong financial performance and good future growth potential.